Welcome, ladies and gentlemen, to the press conference following the quarterly meeting of the Shadow Financial Regulatory Committee. This, as you could, if we have a hard time believing, is the end of our 26th year. First year that we met was 1986. Looking around the room, half of you weren't born yet. And looking at us, we had hair in those days. So we've been doing something right. We'll start the next year with a meeting in February, but we've changed the format of the meeting quite a bit. This is the meeting that we're going to now have once a year instead of every quarter, where we invite a large number of people from the Washington area, whoever have an interest in the topics that we are talking about, which we announce ahead of time. We write 3 to 5 statements, review the statements, and then open it up for Q&A. The other 3 sessions a year will be quite a different format. We have only one topic, and it's very narrowly aimed and targeted at a particular group in Washington. We then invite members of that group, staffers, trade association, lobbyists, etc., to a lunch, and we have an in-depth discussion of that issue over lunch. So we'll probably have this kind of format again once next year, a year from now. I have a couple of announcements. We have some new members of the committee. We have 2 new members with us today. They're both with us. There's Frank Portnoy from the University of San Diego Law School, and David Steele from the University of Pennsylvania Law School. They're sitting on the table up front here. They're both lawyers, and so the statement may have more legal validity than the past, which isn't true because we have Ken Scott, of course, who has carefully watched over us, who will be leaving the committee after its next meeting in February. As you can see from the papers that were handed to you, well, let me introduce the members of the committee who are here. I've introduced the 2 new members. I haven't introduced the existing members. I am George Kaufman, co-chairman of the committee, Loyola University, Chicago. On my left is Dick Herring, the co-chairman from the University of Pennsylvania, the Wharton School. Then let me go to the right here and start over here. I'll start. I know where Frank is. I want to start the people at the head table, then we'll go to the rest of the team. Frank's all by himself here. Let's introduce Frank. He's lonely. We've introduced everybody else at that table. Frank Edwards, from emeritus from Columbia University, now a resident of Florida. And comes up here to see what cold weather is like. On my extreme right here is Bob Eisenbeiss with, I keep forgetting the name of the group you're with. Cumberland Advisors. There's Pete Kyle from the University of Maryland, and Ed Kane from Boston College, again, emeritus, living in Arizona now. He's not emeritus. They didn't give you emeritus standing? He's still active.
I'm a research professor.
He's a research professor
Sure.
at Boston College. And the other members of the committee were in the discussion, but are not at lunch. We have 3 papers, as you can see. The first paper deals with something we do every time there's a biannual election. We have an open letter to Congress recommending both the philosophy and specific items that they should be looking at in the next 2 years. That's Statement 354. Statement 355 is there's been some statements in the press recently about a number of data sources that are released to the public at different times. And some people get early access to these sources and other people who don't. That's become quite controversial, and we comment on that. The last thing is also in the press and being taken up in the next Congress, great deal of concern about the undue influence that the New York Fed may have on large financial institutions, and the closeness of the regulators and the institutions that they're regulating and supervising, and we comment on that. So let's start off with the first statement, 356. Nope.
354.
354. which is the open letter to Congress, and Ed Kane is the author of that statement. Ed,
Well, we're all the author, the entire committee is the author of this statement.
only your name is on it.
But I'm the lead author, if we can say that. We've always given some advice either to Congress or the president after each election. In the past, we've tended to list a number of issues, and this time we decided to focus only on two big issues, and they are financial reform and subsidies to housing finance. These are areas that we think may not be evolving as nicely as we'd like. Now, Socrates warns us that the worst kind of deception is self-deception. And there is wishful thinking here in Washington and abroad that supposes that rulemaking is guided by the Dodd-Frank Act, G20 protocols, and the Basel Committee on Banking Supervision have developed, or will develop, because they're still unfolding, an adequate response to the extensive risk-seeking, rent-seeking, and supervisory breakdowns that actually set the stage for the great financial crisis. So we may believe that the danger of new financial crises remains high, and it's high for two reasons. First, because risk-taking in complex financial companies and derivatives markets is becoming less rather than more transparent. It's harder to see than ever. And because the organizational cultures of financial institutions and of their regulators remain deeply flawed. There's just an awful lot of incentive conflict and a failure really to serve the needs of society as a whole. At these very mega firms, the firms we loosely call too big to fail, the incentive structures support an ethical climate in which managers cover up and deny the extent to which they're using aggressive risk-taking to extract subsidies through the safety net, and incentive conflicts in government agencies, including the revolving door, make top regulators reluctant to challenge the deception. They go along with it. They don't rock the boat. Some of that is called regulatory capture, which we'll be hearing more about later. Safety net subsidies encourage innovations that are designed to make the risk-taking harder to see, harder to monitor. That's why it is moving in that direction. And they also encourage efforts to make the organizations that enjoy these too big to fail guarantees politically, administratively, and economically more difficult for government officials to regulate or unwind failing institutions. So the Dodd-Frank Act and the subsequent rulemaking has increased regulators' authority over financial institutions. So the authority has increased. They got way more powers, but it hasn't addressed the practical difficulties regulators face in exercising this authority, particularly exercising this authority in times of economic distress. It's clear that sharply increasing capital ratios for institutions that are difficult to regulate or unwind would improve incentive structures, at least in these firms. But the Shadow Committee believes that the complex definitions of loss-absorbing capital for capital requirements that surfacing in proposed capital standards around the world, but particularly in this country, will encourage counterproductive regulatory arbitrage. There'll just be a lot of churning of institutional forms, new instruments introduced, new fund kinds of hedge funds and so forth. So much of the complexity in these standards, which is the point we're addressing, traces actually to differences in the ways that the U.S. and other tax codes treat dividends on stock as opposed to interest payments on various forms of hybrid debt that has some connection to equity in difficult circumstances. By those we mean contingent capital and subordinated debt. So our committee urges Congress to encourage the simplification of these capital requirements, and it can do this, it can reinforce efforts to define regulatory capital at institutions more simply by taxing income from both instruments, that is hybrid instruments and stock, in exactly the same way. You can do this either by making dividends on bank holding company stock tax deductible, or by eliminating the deductibility of interest on subordinated debt. In the U.S., the first approach would lower the cost of equity. The second would equalize the cost of subordinated debt and contingent capital obligations. Either could be done in a tax-neutral way as part of a corporate tax reform package, and there's a lot of discussion of having such a package. Now, our second issue concerns subsidies to mortgage finance, and we've repeatedly stressed in these meetings the need for Congress to redefine the federal government's role in housing finance. We urge Congress to work with the administration, lots of luck, right, to end the conservatorships of Fannie Mae and Freddie Mac, and to make the costs of federal home ownership and home building programs observable to ordinary citizens. Fluctuations in housing activities and housing prices would become less intense if Congress were to transform its long-standing below-the-radar off-budget efforts to promote housing by subsidizing mortgage loans for everybody into direct and explicit subsidies that are targeted to specific classes of recipients, such as low and middle income, if you want to go to that, homeowners. And you could do this at known costs that would be subject to budget review. That's the trouble. Nobody reviews these things until there's a breakdown. So this would allow detailed decisions about mortgage terms and availability, which are very politicized today, to be handled in the private sector. Thank you.
Thank you, Ed. We're going to hold up the discussion of the statement for the law second statement is the statement
Thank you, George. There's a perception that there's a condition of undue influence on the part of Wall Street, particularly the Federal Reserve System as a whole and the New York Fed in particular. And proposals have been put forth as a way of dealing with this supposed close link would be to have the President of the United States appoint the President of the Federal Reserve Bank of New York and have that appointment confirmed by the Senate, as opposed to having the President selected by the bank's Board of Directors, which is the process by which all the Federal Reserve banks select the presidents. We feel that there are other important and potentially structural explanations to understand this close connection that exists between the New York Bank and the Board of Governors, and particularly it relates to the special role that the primary dealers play through the New York Bank in the implementation of monetary policy. The primary dealers are a small group of qualified in the sense that the Federal Reserve Bank of New York, through the open market desk, determines that these institutions are dealer institutions with which they can deal on a day-to-day basis with monetary policy. We think that there are other ways, and perhaps more effective ways, to reduce and respond to this perception of influence. And we made 3 recommendations, and I'll go into a little bit more detail once I indicate what they are. First, we would recommend that because of the changes in technology, that there's really no logical reason for maintaining this primary dealer relationship as the main mechanism for the conduct of monetary policy on a day-to-day basis. Secondly, we suggest that one of the things that could be done is to rotate the operation of the desk, because of technology, which makes that quite feasible, among at least 2 and maybe more Federal Reserve banks. This would have an additional benefit of providing a backup facility that would be fully functioning in the event of a 9/11 type tragedy, would be a source of strength, in a sense, to the U.S. financial system. And third, what we would recommend is that the President of the New York Fed, which presently is a permanent member of the FOMC and by law vice chairman of the FOMC, be removed and rotated just like everybody else, all the other presidents around the system each year on the FOMC, and that the FOMC elect the vice chairman each year the same way it elects the chairman of the FOMC. It is not the case that the chairman of the Board of Governors necessarily has to be the chairman of the FOMC, which is a separate legal body, and to which the Federal Open Market Desk actually reports and is an agent for the FOMC. So let me first turn to this issue of the closeness, particularly related to the structure of supervision and regulation of banks. Most people don't realize that it's not so simple. The New York Bank does not have primary responsibility for regulating the large financial institutions in its district. Actually, it's much more complex than that. Many of the institutions are mainly national banks, and so their primary supervisor and regulator is actually the comptroller of the currency here in Washington, D.C. Similarly, the supervision of bank holding companies and banks that's vested with the New York Bank is actually a delegated responsibility from the Board of Governors. And so while the supervision is housed in New York Bank, responsibility for enforcement actions and basic policy is still vested in the Board of Governors here in Washington, D.C. So it's not so simple. There's a layer of checks and balances in some sense, which helps to sort of provide a buffer and a bit of insulation. So we really feel that this kind of deference that people are concerned about is probably much more rooted in the relationship between the New York Bank, the Open Market Desk, and the primary dealers, which is the main conduit for the conduct of monetary policy. So we've come up with these recommendations, as I've already indicated, as a way of mitigating that perceived link. And so, again, what we would say is we would expand the range of participants who are allowed to bid on a daily basis, open it up to all the member banks in the same way and parallel to the way the ECB presently deals with its counterparties for the implementation of their policy. They have over 500 counterparties they work with, as opposed to less than 24, which the Federal Reserve Bank of New York is presently dealing with. Rotating the responsibilities of the desk among the various Federal Reserve banks, again, is quite feasible because of technology, and it would diffuse that close relationship that has historically existed between the New York Bank and the Wall Street firms. And finally, as I've said before, we would recommend removing the president of the Federal Reserve Bank of New York as a permanent member of the FOMC and rotating both that position among the various other Federal Reserve Bank presidents and also elect the vice chairman of the FOMC. We figure these would be structural changes. In fact, a couple of them can be done, or could be done, by the Federal Reserve system itself if it chose to do so without congressional action. And that's really opening up the bidding process to a wider range of financial institutions and rotating the responsibilities of the desk. So those could be done by the Federal Reserve system itself. Whether it would happen again or whether there'd be resistance is another matter, but we think that these proposals would go much further along towards resolving a lot of the perceived conflicts of interest that resulted in substantial subsidies from the Federal Reserve to these primary dealers during the past financial crisis.
Thank you, Bob. Our final speaker is Pete Kyle, talk about the problem of, is there a problem really, of different time releases of important data. Pete?
Yes, this is motivated by some recent papers that academics have written on how information makes its way into the market. One example is the survey of consumers conducted by the University of Michigan, that survey has a number that is released, and when that number is released, it often moves markets. There's a particular time at which the number is released to almost everybody, but early release of that information by 2 seconds has been made available to certain privileged subscribers, and they've been able to trade in the 2-second period of time using electronic algorithms to essentially pick off orders in the limit order book and make a profit at the expense of other traders in the market. A lot of people have perceived that to be unfair. Another example that's quite similar is that the SEC collects data on insider trades and puts them into a database and releases those to the public, but the way in which those data had been released allowed certain people with really good electronic access to learn about the data faster than other people in the market and trade on the insider trading reports ahead of other people. So many people probably think this is just unfair and it should be banned on the grounds of fairness, but we have a different take on it. We think it should also be limited, but on grounds of economic efficiency. So think about what happens if you're a trader with an order in the limit order book and somebody sees this data before anybody else, and your order happens to be on the wrong side of the market. It will get picked off, the market will move right through you, and you'll immediately be underwater on your trade. Well, what does that do to you? That increases your cost of trading. It makes your transactions costs higher. And whatever benefit it is that you were getting from the market, that benefit has been reduced, and it's going to make you trade less or be more wary of trading in the future. So by giving access to information to everyone at the same time, which is what we advocate, trading costs for investors will fall, and that will make the market function more efficiently in a transactional sense. Now, some people might argue that, well, it's insider trading to get this early peek at the data. We don't think so. We think the insider trading laws probably don't apply to a lot of these situations. And we think, in fact, that it should be implemented in a different way. The right way to implement it, we think, is for there to be a brief trading pause, maybe 5 seconds, maybe 1 minute, during which time the information is released. And then the market reopens with everyone having access to that information and everyone able to trade at the same time. So if you had an order at the market that was previously going to get run over, you would get the benefit of price improvement as a new auction would open the market at a price level that reflected the value of the securities. So that makes them, this would give you a better price, lower your trading costs, and make the market more liquid for you, and in this sense would be beneficial. But we have to be careful and think beyond this. There are many people who, we think that our proposal applies to information that is released by governments or information that is released by nonprofit organizations like the University of Michigan. That this is information that's going to be released anyway, and it's not like the information is never going to be produced if you change the terms upon which it's made available to the market. But there's a lot of other information there that is essentially sold by subscription, and the only reason for the information to exist at all is your ability to sell the information or to trade on it yourself. That's hard research that people conduct is quite costly, and research that's incorporated into prices makes the prices more accurate signals that guide investment decisions and otherwise guide economic activity. So we would allow people who are conducting for-profit research to trade on or to sell to continue conducting their business as usual. Now, the efficiency argument has one final step, which is that if you take the information that's released publicly and make it available to everybody simultaneously and increase market liquidity a little bit as a result of doing that, that increased market liquidity actually provides an increased incentive for other people to produce information for private gain. And in the end, what we think will happen will be, as a result of our proposal, markets will be a little bit more liquid, and that's beneficial to everybody because it makes trading costs lower. And at the same time, there will be slightly more information produced privately because markets are more liquid, and that will make prices more accurate signals for allocating resources. So it's a win-win proposition for markets viewed from the perspective of economic efficiency.
Audience, Please state your name, your affiliation, and direct your question to any particular member of the committee, either sitting at the head table or sitting on the table to my left. Who has a question? Yes, sir.
Thank you. Hi. Philip Ulevsky with McCain Institute. This is for Dr. Kane. You mentioned about reforms in the housing market. Now, PATH Act, there are some concerns about forcing private shareholders into bankruptcy. Johnson Crapo doesn't seem like a perfect solution. How do you see this developing, and do you think there's something going to come out in the next Congress?
Well, housing finance is very well lobbied, and what has been going on is just a stalemate. It's not a stalemate of Democrats versus Republicans. It's a stalemate of lobbyists who don't want to see things worse for them or their organizations than it is now. Eventually these conservatorships have to end. But there's a very good chance that, in my mind, only in my mind now, that Fannie and Freddie will be merged down the line and re-privatized, which probably means kept as government-sponsored corporations with implicit guarantees, but there'll be a lot of hand-waving about how we've taken the government out of it. Maybe we'll adopt the word federal out of this new one, called the Housing Finance Corporation or something. But, that's very hard to predict because the circumstances could change. I mean, housing is now recovering slowly and variably. I mean, it isn't like steadily every month. And the Fannie and Freddie have been providing the bulk of the finance. So in that sense, housing hasn't been stalemated, but the financial industry wants to get the securitization of mortgages back in their hands to a greater degree. So they have an incentive to find a solution that would leave them with an opportunity, a better opportunity, expanded opportunity. excuse me. But they don't want to get those guarantees out of the picture either. So we just have to wait and see how it plays. But I think it is very likely that Fannie and Freddie have talked about merging their back office. And once they've done that, why not merge the front office too?
Ed Berger. I'm prone to address the issue called New York Fed and primary dealers. The prefatory comment in this statement speaks of a perceived problem of undue influence of large Wall Street financial institutions over monetary policy. Is it the opinion of the committee that there is, in fact, undue influence?
That's a good question. I think when you look at the kind of support that those institutions received, it's hard to justify in one respect. On the other hand, we don't fully know the extent to which this was based on broader financial market concerns about derivatives and related counterparties and all the rest. But clearly, at the same time, it's pretty obvious that if those institutions went under, and a couple of them did, Countrywide was one in particular, that it would have severely impacted the ability of those firms and the Fed to conduct monetary policy. So, I think there clearly is a close relationship. I think it's primarily explained by that linkage through the monetary policy and the desk. And, I think we have to be concerned about that and all of the systemic risk and the moral hazard elements that go along with that perception on the part of the market that these institutions are too big to fail.
Can I get in? The word perception is, that's what's important. The perception that, for instance, when one of these firms gets in trouble, the government will stand behind them and deliver help. And I think the committee was trying to avoid getting into the weeds where we might have some disagreement. I feel in the open letter we used the term of the organizational culture. And if you know how they talk about organizational cultures in sociology, they say there is the professed norms of an organization, the ones that they say, this is our mission, what we're trying to do, which is, in the case of the Federal Reserve and the other regulators, to make things more stable and more efficient and fairer. That's the professed norms. Then they have some tools that they use for that, like capital requirements. Then the last thing, and the important thing, is an unprofessed set of norms, norms that are deeply embedded in how people get ahead in this organization and how they actually operate. And I think the norms in the U.S., in our regulatory agencies, include one of being helpful to the industry. That other things equal, you want to help the industry. Also, to be merciful for firms that get in trouble. Don't just jump in and close them, but see if you can keep them going. And then finally, there's a norm about helping them compete with foreign firms in the same space. And I think those interfere with, that's where the incentive conflicts come from. That to serve taxpayers, you want to protect the extent to which the safety net is putting money into these firms, shall we say. And so so these professed norms, professed missions or conflict with these deeper norms. You know, another norm I could have mentioned is one about not rocking the boat. You know, they go along with the agency and don't challenge its actions. And if you do, this is very likely to interfere with your career progress. That's the
And
opposite.
this perception has multiple dimensions, as Ed is suggesting. We know that there's ample evidence that Lehman Brothers perceived that it would be rescued, and obviously didn't turn out to be the case. So management perceived in this one case. Other instances, markets perceived that these institutions were special. It goes back to approximately 1993 when Jerry Corrigan, who was then president of the New York Fed, actually put forward some policies that the FOMC approved where they would no longer monitor the health of the primary dealers, but rather rely on collateral. And this was due to try to ameliorate the market perception that these institutions were special. Well, obviously, subsequent events proved that, in fact, they were special, even despite the attempts to deal through policy with that perception. So this is part of what we're trying to address here as a way of reducing those kinds of perceptions and any potential for conflict that might arise out of those perceptions.
I might note that even if there was not a conflict, times change, and when the primary dealers were put in, it was a very different world. Technology has advanced, as the statement says. The primary dealers are not unique in any sense anymore. So even without a perception of favoritism or subsidy, you would want to take a look at, is this the most efficient market structure? And we argue that it is not. Satisfied all of you? Yeah. Excuse me? Somebody want to speak back there? I don't see him.
Okay.
Oh.
I was noticing Peter Walson is sitting in the back. He's a former member of our committee. Yeah, and Peter has never been in a situation where he didn't have a question. No questions, no statements?
Well, if there's nobody has any question, let me thank you for coming. Wish you all happy holidays. and we'll probably have one of these sessions again a year from now, and we'll see you then. Thank you very much.